For nearly 2 decades, these two lines moved in near perfect unison. The red line is the S&P 500 energy sector, and as that has gone up and down, so too has the price of oil. When energy companies grew, they hired more and drilled for more oil, and their stocks followed the price of the barrel. But in 2022, that relationship broke down. Since then, oil prices have gone down from $120 a barrel to just over $60. But at the same time, energy stocks have gone the opposite direction, staying right up near their all-time highs around $130. This divergence points to a fundamental shift in the way the energy sector operates and its role in the stock market. For a long time, the energy sector was all about growth. This is the money U.S. oil companies were taking in from 2016 to 2020, and this is how much they spent on drilling and exploration. They reinvested nearly every dollar of profit into drilling for more oil instead of into shareholders' pockets. This led to a huge surge in oil production known as the shale boom from 2010 to 2020, which contributed to an oversupply of oil which peaked in the mid-2010s. This supply glut caused oil prices to plunge several times in the mid-2010s, most notably in 2014 when prices fell from $112 a barrel down to a low of $35 a barrel in early 2016. This happened again in 2019 due to slowing demand and rapid production. Oil prices are highly volatile since they're so sensitive to potential supply shocks that may come about from wars and unrest, such as this peak in 2022 that came when Russia invaded Ukraine. But that spike was short-lived, and the general trend of oil prices over the past 15 years has been downward to where it rests today just above $60 a barrel. And investors felt this in their wallets during the shale boom of the 2010s. From 2015 to 2021, shareholders saw disappointing returns from U.S. oil companies compared to the rest of the market. They were basically flat. After prices and returns slumped again in 2019 and into 2020, investors had enough. They stopped rewarding growth and started demanding returns, and the oil companies obliged. After 2020, their cash from operations rose by 8 times, so they were taking in double what they were spending on drilling. The rest they returned to investors through share buybacks and dividends, and returns for shareholders rose significantly from 2020 to 2023. Oil companies were able to make this pivot because of one thing: efficiency. As oil production ramped up during the shale boom, the number of rigs in operation has actually been declining. In 2011, the US had 2,000 working oil rigs. Today, that's fallen to just over 500. This shows that oil companies have become much more efficient at extracting crude. And the break-even price for a barrel of oil in the Permian Basin has fallen from $90 a barrel in 2012 to $40 today. And that means they're generating much more free cash flow because they're spending less on new drilling and have higher profit margins, even with falling oil prices. Big oil companies' free cash flow was nearly $100 billion in 2025, with oil price averaging around $65 per barrel. That's about as much cash as in 2008 when oil prices were $100 a barrel. Artificial intelligence has certainly helped improve oil drilling efficiency, but it's also fundamentally changed demand in the energy sector. The AI boom has driven a huge wave of energy-hungry data center construction, requiring huge amounts of constant, reliable energy to power them, which renewables can't always provide. So they're leaning on natural gas, which is a byproduct of oil extraction. It's also cheaper and cleaner to burn than oil, and because of that is sometimes seen as a transition fuel as oil demand gradually decreases. This means that many companies in the XLE are actually shifting focus away from oil and towards natural gas to fill this demand and to be more future-proof. And declining oil prices are a double-edged sword. On the one hand, lower oil prices mean less profit from selling oil, but big oil companies like Exxon and Chevron don't just pump oil, they also refine it into gasoline. And for that section of the business, cheaper oil means cheaper refining because the raw material is cheaper. So lower oil prices like we're seeing today can actually increase profit margins in the refining part of the business. The divergence between oil prices and energy stocks points to a fundamental change in how traditional oil companies are doing business and how they're being treated by investors. The energy sector has shifted from a speculative growth investment to a defensive stock, more like a stable utility. Investors are looking to the XLE for reliable cash, and if AI continues to grow and build data centers, that could be bullish for the energy sector, which will be needed to power it. But this can only continue as long as oil prices stay above the break-even price, which is a red line. This depends on the region, but in the Permian Basin of the US hovers around $40 to $50. If oil prices fall below that level, it would begin to undercut profits and could cause a contraction and recoupling of the energy sector and oil prices as they fall. At Capital.com, we'll keep you updated on the latest in oil and commodity prices in the energy sector. Hit like and subscribe to stay tuned. Thanks for watching.